projected 50% increase in restructuring activity across banking, real estate, and manufacturing sectors by Q2 2025. International competitive landscape and expert insights. Overview. As we move towards the second quarter of 2025, the banking, real estate, and manufacturing sectors are poised for a significant transformation marked by an anticipated 50% increase in restructuring activities. This surge is largely driven by macroeconomic challenges, regulatory changes, and advancements in technology. Insights garnered from authoritative sources such as Deloitte and PwC illustrate the complex interplay of these factors and their implications for global business strategies. Macroeconomic environment. Banking sector challenges. The banking industry is grappling with a low-growth environment characterized by declining interest rates and increased deposit costs. These factors have constrained net interest income, creating pressure on traditional banking revenue streams. However, there are emerging opportunities in non-interest income, particularly in investment banking and asset management, as the demand for advisory services increases amid a recovering economy. Key factors. Interest rate dynamics. A forecasted decline in interest rates is expected to improve consumer loan demand, particularly for mortgages. However, credit card and auto loan growth may remain sluggish due to rising consumer debt levels. Consumer behavior. With consumer debt reaching record high, spending is anticipated to slow. This trend could hinder the growth of retail banking revenues, leading banks to explore innovative non-interest income strategies. Real estate sector recovery. The commercial real estate (CRE) sector, after enduring prolonged challenges due to high interest rates and inflation, is showing signs of optimism. Executives in the industry are increasingly confident, with 88% expecting revenue growth by 2025, up from 60% in the previous year. Key insights. Interest rate projections. A potential easing of interest rates is expected to stimulate market activity, particularly in sectors such as industrial and residential real estate. Sustainability trends. There is a growing emphasis on sustainability within real estate, with firms investing in climate-resilient properties to meet emerging regulatory standards and consumer preferences. Technological advancements. The role of AI. The integration of artificial intelligence (AI) is a pivotal theme across all sectors. In banking, AI is seen as a key driver for modernization and efficiency. A staggering 97% of real estate executives recognize the necessity for AI-enabled solutions to enhance operational performance. Technological applications. Predictive analytics. In real estate, generative AI is being utilized for predictive analytics, helping firms make informed investment decisions and optimize property management. Operational efficiency. Banks are increasingly adopting AI for operational tasks, aiming to reduce costs and improve customer service through automation. Regulatory landscape. Basel III reforms. The anticipated Basel III Endgame reproposal suggests a reduction in capital requirements for banks, which could stimulate mergers and acquisitions among smaller institutions. This regulatory shift aims to create a more level playing field and enhance banks' capital management strategies. Implications. M&A activity. The easing of capital constraints is likely to lead to increased merger and acquisition activities, particularly among mid-sized banks seeking to enhance their market positions. Compliance costs. As new regulations take effect, banks will need to navigate increased compliance costs, further emphasizing the need for efficient operational frameworks. Strategic insights and trends. 1. Restructuring as a response. Firms across sectors are preparing for significant restructuring. This aligns with the broader economic context, where companies are adapting to shifting consumer demands and regulatory environments. 2. Optimism amid uncertainty. Despite the challenges, executives express cautious optimism. The expectation of revenue increases reflects a recognition of the potential for recovery, particularly as interest rates stabilize. 3. Technological integration. The focus on technology, particularly AI, is a unifying theme across sectors. Organizations are investing in digital transformation to enhance decision-making and operational efficiency. Regional variations. Insights from Deloitte highlight the differing recovery trajectories across regions, notably between North America, Europe, and Asia Pacific. Each region faces unique economic conditions that influence executive sentiment and strategic planning. Regional considerations. North America. Banks in the U.S. are expected to face greater competition from non-bank financial institutions, prompting a recalibration of business models. Europe. European banks may struggle with profitability as they adapt to a prolonged low-rate environment. Asia Pacific. Emerging markets in Asia Pacific are anticipated to experience stronger results, supported by robust economic growth. Timeline of events. Pre-2024, the banking and real estate sectors navigate elevated interest rates and inflation, leading to defensive strategies. 2024, central banks signal potential interest rate cuts, fostering optimism in the CRE sector. Surveys reveal increasing revenue expectations among real estate executives. Q2 2025, the projected 50% increase in restructuring activities coincides with lower interest rates and a broader recovery sentiment in banking and real estate. Conclusion. The anticipated restructuring surge by mid-2025 marks a critical juncture for the banking, real estate, and manufacturing sectors. Companies must navigate economic uncertainties while embracing technological advancements and adapting to evolving regulatory landscapes. The strategic approaches adopted now will be crucial in positioning organizations for sustainable growth in an increasingly complex global market. The insights provided by industry leaders underscore the importance of agility and foresight in navigating the impending changes. With a strong emphasis on technology and compliance serving as the foundation for future success. The projected 50% increase in restructuring activity across the banking, real estate, and manufacturing sectors by Q2 2025 is driven by several counterintuitive dynamics that challenge traditional expectations about economic recovery and sectoral performance. Here are some key points of counterintuitive information. 1. Banking sector's non-interest income resilience. While the banking sector is expected to struggle with low net interest income due to declining interest rates and high deposit costs, it paradoxically anticipates growth in non-interest income, particularly in investment banking and asset management. This suggests that banks are diversifying their revenue streams to mitigate the impact of a low-rate environment, countering the common perception that banks primarily rely on net interest income for profitability. 2. Cautious optimism in commercial real estate CRE, despite a backdrop of elevated interest rates and economic uncertainty. 88% of executives in the CRE sector expect revenue increases by 2025, a significant rise from 60% the previous year. This optimism against the grain of prevailing economic challenges indicates a potential underestimation of the recovery trajectory in the real estate market, particularly as interest rates are projected to decline. 3. Artificial intelligence. AI as a double-edged sword. AI is viewed as a transformative force that can enhance operational efficiencies across sectors. However, the real estate sector recognizes that before widespread AI adoption can occur, foundational challenges such as data quality and reliability must be addressed. The expectation is that AI can drive modernization, yet the sector grapples with the readiness of its data infrastructure, suggesting that the pace of AI integration may not be as fast as anticipated. For regulatory changes in M&A activity, the Basel III Endgame reproposal is expected to lower capital requirements for smaller banks, potentially spurring M&A activity among these institutions. This counters the typical narrative that regulatory changes always tighten capital constraints. Here it may actually create a more favorable environment for consolidation among smaller players, thereby reshaping competitive dynamics in the banking sector. 5. Climate resilience versus financial viability. The imperative for sustainability and climate resilience in real estate is juxtaposed against the financial viability of investments. While there is a strong push for deep energy retrofits and compliance with sustainability standards, the reality is that many firms still prioritize short-term financial performance over long-term environmental goals. This creates a tension between the need for immediate financial returns and the longer-term benefits of sustainable practices, an irony that complicates decision-making in the sector. 6. Global economic divergence. The projected economic growth rates exhibit significant regional variance, with North America expected to slow while Europe and Asia-Pacific show resilience. This divergence challenges the notion that global economic trends uniformly influence all markets. Instead, it highlights that localized factors such as regulatory environments and regional economic policies can lead to vastly different recovery trajectories. 7. Consumer debt and spending. As consumer debt reaches record highs, it is expected to restrain spending, countering expectations that lower interest rates would universally lead to increased consumer activity. This reflects a nuanced understanding that while lower rates may stimulate certain areas, overarching consumer financial pressures could dampen the anticipated economic rebound. 8. Technology investment amid economic uncertainty. Companies across sectors are poised to increase their technology spending, particularly on AI and digital transformation, even as they face economic headwinds. This suggests a strategic pivot where businesses prioritize long-term technological advancements despite short-term financial pressures, which is contrary to the conventional approach of cutting technology investments during downturns. These counterintuitive insights reflect a complex interplay of factors influencing the projected restructuring activity across key sectors, illustrating how traditional economic models may not fully capture the evolving landscape of global markets. Organizations must navigate these dynamics carefully, balancing immediate performance with future growth potential. The report on the projected 50% increase in restructuring activity across the banking, real estate, and manufacturing sectors by Q2 2025 reveals several key insights that may be overlooked by many readers. Here I will highlight these significant aspects and explain their importance for stakeholders in these industries. 1. Regulatory changes and their implications. One of the most critical yet often overlooked aspects is the impact of the Basel III Endgame reproposal on smaller banks, which suggests a reduction in capital requirements. This regulatory adjustment is expected to foster greater M&A activity among smaller banks. The significance of this lies in the potential for a more dynamic banking landscape where smaller banks can optimize their capital structures, thus enhancing their competitive stance against larger institutions. This shift not only affects the banking sector but also has ripple effects across the entire financial ecosystem, potentially influencing lending practices, interest rates, and credit availability for businesses and consumers alike. Stakeholders should pay attention to how these changes could create opportunities for growth and consolidation in an otherwise challenging economic environment. 2. Technological adoption and AI integration. The report emphasizes the urgent need for AI integration, particularly in the banking and real estate sectors. While many executives recognize this necessity, the report highlights that data quality and reliability remain significant challenges. This aspect is crucial because the successful deployment of AI tools hinges on the availability of accurate and well-structured data. Failing to address data quality can lead to misguided decision-making, which can adversely affect operational efficiencies and strategic planning. Organizations that underestimate the importance of robust data governance may struggle to fully realize the benefits of AI, putting them at a competitive disadvantage. Thus, stakeholders must prioritize data management as a foundational step for successful AI adoption. 3. Cautious optimism in the real estate sector. While the report reveals a general sense of optimism among real estate executives, it is essential to note that this optimism is tempered by caution regarding elevated interest rates and refinancing risks. The impending wall of loan maturities presents a significant challenge. with billions in commercial mortgages needing refinancing under potentially less favorable conditions. Understanding these dynamics is pivotal for investors and stakeholders as they navigate the recovery phase. The potential for a mismatch between expected revenue growth and actual market conditions could lead to increased defaults and financial strain for real estate firms. Hence, stakeholders must assess their portfolios critically, considering the timing of loan maturities and market conditions before making investment decisions. 4. Sustainability and climate resilience. The emphasis on sustainability in the commercial real estate sector is a vital theme that may not receive the attention it deserves. The report discusses the increasing importance of deep energy retrofits and compliance with new performance standards as a means to enhance building value while addressing climate change. This focus is significant for stakeholders because regulatory pressures and changing consumer preferences are pushing firms toward sustainable practices. Companies that proactively invest in sustainability may not only mitigate risks associated with climate change but also enhance their reputational capital and long-term profitability. Therefore, stakeholders should recognize sustainability as a strategic priority rather than a regulatory burden. 5. Diverging recovery trajectories across regions. The report indicates that recovery prospects vary significantly across regions, particularly between North America, Europe, and Asia Pacific. This regional divergence suggests that stakeholders must tailor their strategies based on local market conditions and regulatory environments. Understanding these differences is crucial for investors and businesses looking to expand or allocate resources effectively. Ignoring regional dynamics could lead to misaligned strategies that fail to capitalize on local opportunities or underestimate potential risks. 6. The skill gap and workforce dynamics. An often overlooked aspect is the skills gap within the sectors discussed, particularly in banking and real estate. The need for upskilling and reskilling employees to meet the demands of a rapidly changing technological landscape is paramount. As organizations adopt advanced technologies like AI and data analytics, the workforce must evolve to leverage these tools effectively. Failing to address this gap could result in operational inefficiencies and a lack of innovation. For stakeholders, investing in training and development initiatives is not only a matter of compliance but also a strategic imperative to ensure long-term competitiveness. 7. M&A activity as a strategic lever. The anticipated increase in M&A activity, particularly among smaller banks and real estate firms, signals a strategic shift in responding to market conditions. This trend presents both opportunities and risks for stakeholders. For instance, companies engaging in M&A can achieve economies of scale, diversify their offerings, and enhance market share. However, they must also be cautious of integration challenges and cultural mismatches that can arise from mergers. Stakeholders should closely monitor M&A trends and consider how these changes may impact their strategic positioning and competitive landscape. Conclusion. The projected increase in restructuring activity across banking, real estate, and manufacturing sectors by Q2 2025 is a multifaceted issue that encompasses regulatory changes, technological advancements, sustainability efforts, and regional dynamics. By paying attention to these often overlooked aspects, stakeholders can better navigate the complexities of upcoming changes and position themselves strategically for future growth and resilience. The report serves as a call to action for executives and decision-makers to not only prepare for change but to actively engage in shaping the future of their industries. 1. Macroeconomic environment and its implications for restructuring. The projected 50% increase in restructuring activity within the banking, real estate, and manufacturing sectors by Q2 2025 is heavily influenced by the macroeconomic environment. Factors such as low economic growth, declining interest rates, and high deposit costs in the banking sector create a challenging landscape for financial institutions. These conditions limit net interest income, driving banks to seek alternative revenue streams. The commercial real estate sector, conversely, is showing signs of optimism, particularly as interest rates are expected to decline, with 88% of executives anticipating revenue growth. This presents a dichotomy. While banks are focused on cost management and restructuring, the real estate sector is looking towards recovery and potential growth. Analyzing the implications of these macroeconomic factors provides insight into the strategic responses organizations must adopt to navigate a complex and evolving landscape. 2. Technological advancements and the adoption of AI. Technological integration, particularly through artificial intelligence (AI), is a common theme across all three sectors facing restructuring. The banking sector sees AI as a tool for modernization, with banks aiming to enhance operational efficiency and customer experience. In the real estate sector, executives recognize the necessity of AI for predictive analytics and operational improvements. However, the path to AI adoption is fraught with challenges, including issues of data quality and reliability. The emphasis on AI underscores a broader trend towards digital transformation, where companies must embrace technological advancements not only to enhance productivity but also to remain competitive. An in-depth discussion of how organizations can effectively implement AI solutions, address technical debt, and leverage data for strategic advantage is essential as these technologies reshape industry dynamics. 3. Regulatory landscape and its impact on restructuring activity. The evolving regulatory landscape, particularly with the Basel III Endgame reproposal, is poised to influence restructuring activities significantly. By potentially lowering capital requirements, smaller banks may find themselves with greater opportunities for mergers and acquisitions, which could lead to a wave of consolidation in the banking industry. In the commercial real estate sector, compliance with new tax policies and sustainability measures will also require firms to adapt their strategies. Aligning financial and environmental objectives. A discussion on how these regulatory changes will impact strategic decision-making processes across sectors can provide valuable insights into the future landscape of banking and real estate industries. 4. Optimism in the face of challenges, revenue growth and future outlook. Despite the uncertainties presented by macroeconomic pressures and regulatory changes, there is a notable optimism among executives within these sectors. The expectation of revenue growth in commercial real estate is indicated by the substantial increase in positive sentiment from executives, contrasts with the more cautious approach taken by banking leaders focusing on cost management. This optimistic outlook reflects an ability to adapt and pivot strategies in response to changing market conditions. Analyzing this optimism alongside the challenges that lie ahead can reveal the resilience of these sectors and the strategies that organizations may employ to capitalize on emerging opportunities while mitigating risks. In conclusion, the anticipated increase in restructuring activity across banking, real estate, and manufacturing sectors by Q2 2025 is influenced by a complex interplay of macroeconomic conditions, technological advancements, regulatory landscapes, and a prevailing sense of optimism. An in-depth analysis of these factors offers a comprehensive understanding of the strategies and adaptations required for organizations to thrive in an increasingly competitive environment. Here are three famous historical cases that highlight significant restructuring activities in banking, real estate, and manufacturing sectors. 1. The 2008 financial crisis. Sector: banking and real estate. Description: the financial crisis of 2008 was a pivotal moment in global financial history, leading to widespread restructuring in the banking sector and impacting the real estate market significantly. The crisis was primarily triggered by the collapse of the housing bubble in the United States, which was fueled by subprime mortgage lending practices. As mortgage defaults surged, large financial institutions faced severe liquidity issues. Major banks like Lehman Brothers collapsed, while others such as Bank of America and J.P. Morgan Chase acquired struggling banks to stabilize the financial system. The U.S. government also intervened with bailout packages, including the Troubled Asset Relief Program (TARP), which aimed to restructure and stabilize the banking sector. The aftermath saw heightened regulation through measures like the Dodd-Frank Act, which aimed to prevent a similar crisis in the future. 2. General Motors bankruptcy and restructuring 2009. Sector: manufacturing. Description: in June 2009, General Motors (GM) filed for Chapter 11 bankruptcy, marking one of the largest bankruptcies in U.S. history. The automotive giant faced a multitude of challenges, including declining sales, rising labor costs, and the global financial crisis, which severely impacted consumer demand. The U.S. government intervened with a bailout plan that included financial assistance and a structured bankruptcy process. As part of the restructuring, GM closed plants, cut jobs, and renegotiated labor contracts, ultimately emerging from bankruptcy in November 2009. This restructuring allowed GM to refocus its business model, enhance operational efficiencies, and invest in new technologies, positioning the company for a stronger recovery in the subsequent years. 3. The dot-com bubble burst 2000 to 2002. Sector: technology and real estate via tech investments. Description: the burst of the dot-com bubble in the early 2000s led to significant restructuring across various sectors, particularly in technology and related investments in real estate. Companies that had rapidly expanded during the tech boom faced dramatic declines in stock prices and market valuations. Many startups failed, and established companies like Cisco and Amazon had to re-evaluate their business strategies. This period saw massive layoffs, consolidation, and a shift towards sustainable business models. Real estate investments tied to tech companies also faced challenges as the demand for office space fluctuated with the changing fortunes of tech firms. The restructuring during this time involved refocusing on profitability rather than rapid growth, laying the groundwork for the tech industry's recovery and future growth phases. These cases exemplify how macroeconomic pressures, regulatory changes, and shifting market dynamics can lead to restructuring across various sectors with long-lasting impacts on the competitive landscape. Future outlook: projected 50% increase in restructuring activity across banking, real estate, and manufacturing sectors by Q2 2025. Introduction. As we approach the mid-2020s, significant changes are anticipated across the banking, real estate, and manufacturing sectors, prompted by a combination of macroeconomic pressures, regulatory shifts, and technological advancements. Predictions suggest a 50% increase in restructuring activities within these industries by Q2 2025. This surge is expected to reshape the competitive landscape and influence strategic decisions. Key trends influencing restructuring activity. 1. Macroeconomic environment. Banking sector. The banking industry is bracing for challenges stemming from prolonged low economic growth and declining interest rates. While net interest income may be adversely affected, non-interest income streams, particularly in investment banking and asset management, are projected to flourish. As economic conditions stabilize, banks will likely focus on optimizing their operations to enhance profitability. Commercial real estate (CRE). A potential recovery in the CRE sector is anticipated as interest rates are expected to decline. This shift could create a more favorable market environment, encouraging investment and development. Executives in the sector are showing optimism, with a majority expecting revenue increases as market conditions improve. Manufacturing sector. The manufacturing industry faces a dual challenge of rising costs and supply chain disruptions. However, as companies adapt and innovate, a resurgence in domestic production and investment in new technologies is likely paving the way for restructuring. 2. Technological advancements. The integration of artificial intelligence (AI) across sectors is becoming a game changer. In banking, AI is seen as a catalyst for modernization, enhancing decision-making processes and operational efficiencies. Real estate firms are increasingly leveraging generative AI for predictive analytics, which could transform property valuation and investment strategies. The manufacturing sector is also expected to embrace AI and automation to streamline operations and reduce costs, leading to more agile supply chains and improved productivity. 3. Regulatory landscape. Changes in regulatory frameworks such as the Basel III Endgame are poised to alter the competitive dynamics within the banking sector. A reduction in capital requirements could stimulate mergers and acquisitions, particularly among smaller banks seeking to enhance their competitive positioning. The CRE sector must navigate new tax policies and building performance standards emphasizing sustainability. Firms that align their strategies with these regulatory shifts are likely to gain a competitive edge. Common themes across sectors. Restructuring is a strategic imperative. Organizations are increasingly viewing restructuring not just as a reactive measure but as a proactive strategy to optimize their operations, enhance competitiveness, and adapt to changing market dynamics. Cautious optimism. Executives across sectors express a cautious optimism about recovery and growth, underpinned by a recognition of the need for adaptability and innovative strategies. Technology-driven transformation. The emphasis on technology integration, particularly AI, is a unifying theme across sectors. As firms seek to leverage advanced tools to enhance efficiency and decision-making. Sector-specific insights. Banking. The focus will shift toward managing costs and enhancing non-interest income streams. As interest rates decline, banks are likely to reassess their loan and deposit strategies, potentially leading to increased M&A activity. Real estate. The shift in sentiment toward revenue growth is notable, with significant investment expected in technology to enhance operational efficiencies. The focus will likely be on sustainable practices and climate resilience as firms adapt to evolving consumer preferences and regulatory demands. Manufacturing. Companies are expected to invest in advanced manufacturing technologies and automation to improve productivity and resilience. The emphasis on reshoring and supply chain optimization will drive strategic realignments and restructuring efforts. Global perspectives and regional variations. North America. The banking and real estate sectors are expected to exhibit a more pronounced recovery trajectory compared to Europe, where regulatory pressures may hamper growth. Europe and Asia Pacific. While European banks face challenges in adjusting to a low-rate environment, Asia Pacific markets are anticipated to benefit from stronger economic growth and increased investment in technology. Conclusion. The projected increase in restructuring activity across the banking, real estate, and manufacturing sectors by Q2 2025 signals a critical juncture for organizations. As they navigate economic uncertainties, embrace technological advancements, and adapt to evolving regulatory landscapes, firms must proactively strategize to remain competitive in an increasingly complex global market. The ability to leverage AI, optimize capital structures, and align with sustainability initiatives will be pivotal in shaping the future landscape of these industries. Organizations that prioritize adaptive strategies and innovative approaches will position themselves for success in the years to come.